Now, most people would not have heard of ARM Holdings, but they design semiconductor chips where their design architecture is used in 99% of smartphones in the world, close to 49% of all semiconductors in the world, and companies like Nvidia, Intel, Qualcomm, AMD, Apple, Google, and Samsung, they all use the ARM chip architecture. So usually I don't like to look at IPOs, but when it's a very established company, which is like a near monopoly in the world, I do pay attention. And they're going to IPO next week. So is this a stock that's worth buying? Let's find out in this video. So the latest buzz in the market is that ARM Holdings is looking to IPO next week. They're going to list their shares on a stock exchange and value the company at about $52 billion, the biggest IPO, tech IPO of this year. And they're looking to sell 9.4% of their shares to the public, which you can buy, and raise about $5 billion. Now, usually, again, I don't like to look at IPOs. However, it's a very established company, like in the past, Visa IPO'd, Meta IPO'd. I paid attention because it could be something interesting. Now, as I mentioned earlier on, most people may not have heard of ARM Holdings, but 70% of people in the world, including you and I, almost every electronic product that we own, our smartwatch, our phones, they all use chips that are designed by the ARM architecture. So a bit of background about this company. So ARM was actually founded by Apple Computers and two other companies back in 1990, led by Steve Jobs. And the company actually was already listed from 1998 to 2016 on both the US exchange and the London exchange. By the way, it is a British company. There was a JV between Apple and two other companies. Then in 2016, SoftBank, the conglomerate, took them over and made them private at about $32 billion. And now they want to relist the company on the US exchange through the American Depository Receipts next week. So what actually does ARM Holdings do? So ARM actually designs the architecture of semiconductor chips where other semiconductor companies like Nvidia, Apple, Samsung, Intel, they will then design and even build their semiconductor chips on top of ARM's architecture. So ARM does CPUs, GPUs, and NPUs. But they focus more on CPUs, or rather that is where they are the strongest in. CPUs are the central processing unit. They're like the brain of a computer that runs the operating systems and applications. So like your smartwatch, your tablet, your computer, your smart refrigerator, your smart TV, they all need CPUs, central processing units, to run the operating system. And most of them are built on the ARM architecture. Now they also do, like I said, GPUs, graphics processing units, as well as NPUs, neural processing units. But CPUs are their main thing. The company makes their revenue from licensing fees and royalties. So anytime a semiconductor company makes a chip based on the ARM architecture, ARM will take a fee. They'll take a royalty, right? So for example, all of Apple's chips are built on ARM architecture. So every time you buy an Apple iPhone and iMac, Apple tablet, ARM will get a fee. Every time you buy an Nvidia CPU chip, ARM will get a fee. Every time you buy a Qualcomm or Samsung chip that's on ARM architecture, ARM will get a fee, right? So they earn all these fees, all these recurring income every single year. And in terms of market share, you can see that they have got a 99% market share in the mobile application processor market. So 99% of smartphones, of tablets that are made by, whether it's again Apple or Samsung, they're all built on ARM architecture. They also own 64% of the embedded computing market, which includes like routers, industrial automation systems. In terms of the data center and cloud market, they are pretty new. They only have got a 5.1% market share. The automotive market, they are new as well. They've got a 10% market share. For the Internet of Things market, they've got a 33% market share. However, for the PC, the personal computer, and the servers market, that is currently dominated by the x86 architecture that was designed by Intel. So x86 has got a 75% market share, but the ARM architecture has a 25% market share and it's growing over time. So is this a company that I would invest in? So as all of you know, I only invest in the top 1% of companies in the world. These are companies that meet my very strict criteria of being a high quality business. And I've got a set of 7 criteria I look at before I invest in a company. Now, the trouble with an IPO is that you don't really have a very long track record in terms of financial statements to assess the company very well. You only have got like the last 3 years of financial statements. So that's the first thing I don't like about IPOs. But like I said, if it's a very established company, then I may consider. So let me run through what I'll look at right now. So the first thing I'll look at is, does the company have a history of consistency, of predictability, of predictable growth in revenue, net income, and cash from operations, and free cash flow. So like I said, the problem with these IPO companies is that I can't look at least 5 years. Usually I want to see at least a 5-year track record of a company, 5 to 10 years. But I only have got 3 years. So let's just look at 3 years. So the first thing I look at would be the revenue from 2021, 2022, and 2023. Now revenue, you can see, has grown from 2021 to 2022, but the last financial year, revenue actually was flat or was down 1%. So one of the reasons that they gave was because a lot of their licensing fees comes from smartphones, and smartphones actually have had a bit of a slowdown over the last year. That's why revenue kind of like stagnated. Okay, fine. Not great, but okay. Next, we look at their net income. So net income, is it growing consistently? So from 544 million to 676 million, but the last financial year, their net income down 4.5%. So again, it's not that great, because a great business, you want to see the growth of the revenue, profits, and cash flow consistently. Now, of course, sometimes in a year, if profit drops, it's fine as long as revenue continues growing. Like in the case of Meta or Amazon, their revenue grows. So even though their profit dropped temporarily because of high expenses last year, I was forgiving. But in this case, you can see that their revenue did not grow. Their revenue actually went down by 1%. So that's something that is a bit concerning, okay? Now, then we look at free cash flow. So free cash flow, I also want to see it increasing consistently. So that's something that's not that great here as well. You can see that free cash flow from $1 billion in 2021 dropped to 346 million. And then, okay, it's up in the last year to 606 million. So I don't see that kind of consistency in the increase in free cash flow. Now, quarter on quarter is a bit more concerning, right? So if we look at the last quarter, ended June 30th, their revenue dropped 2%, but their profit dropped 60%, right? 60%. And it's not because of non-recurring items. Even their operating income that doesn't include the non-operating items dropped more than 50%. So that's a bit concerning. And their free cash flow actually was negative in the last quarter as well. So when I look at the financial statements, it's not as great as what I would like to see in a company. So that's in terms of their profitability. Now, how about their balance sheet? Now, their balance sheet, I must say, looks very, very strong. If you look at their balance sheet, you can see that their current ratio is 3.42. So they've got 3.4 times more current assets than current liabilities. They've got a debt to EBITDA ratio of 0. All right, so essentially they've got no debt. They've got no interest-bearing debt. Their debt to equity ratio is 0.58. So it's a very, very conservatively managed company in terms of debt. It's got very, very low debt. So that's one good thing going for it, right? It's return on equity. If you take the net income, divide by shareholders' equity, it gives you an ROE of 18%, which is pretty good, not bad. We usually look for an ROE of at least 15%. Now, one of the most important things I look at before I invest in a company is I want to make sure the company has got a sustainable competitive advantage that protects it from potential competition and disruption. So we call that an economic moat. So ideally, I want to invest in companies that have got at least a narrow economic moat or a wide economic moat. So what's the case for ARM? So in my opinion, I think that ARM does have a wide economic moat for now. So remember, a moat comes from several sources. For example, a company can have a very strong brand, equity, brand monopoly, economies of scale, barriers to entry, network effect, and high switching costs. So in the case of ARM, I would say that their economic moat, their wide moat comes from number one, their brand equity, their leadership. So everyone in the industry has heard of ARM architecture, and it's got a very strong brand. And of course, their intellectual assets, which is their IP. So ARM Holdings owns a vast library of intellectual property for all kinds of processor designs. So these IPs are essential for the development of new products, and they give ARM a significant competitive advantage. It'd be very costly for any other company to develop their own IPs from scratch. It'll take decades. ARM also has got what we call a network effect and very high customer switching costs. So ARM Holdings has a very large established ecosystem of partners, including chip makers like Apple, Nvidia, AMD, Intel, Samsung. And these partners have invested heavily in the ARM architecture themselves. And you'll face significant switching costs if they decide to switch to a different supplier. So while the probability for their architecture to be disrupted is low, it is not impossible. So let's take a look at the potential disruptors or the competitors that could pose a threat to ARM. So the first potential threat would be the x86 architecture, which was developed by Intel. But personally, I don't see this as much of a threat because the x86 architecture is only mainly used in the PC and server market. Because the x86, basically, their chips are more powerful, but they suck up a lot of energy. So usually when you want to have chips for smartphones and watches, you don't want such an energy sucking device. And that's why people use ARM, because ARM is more energy efficient. So x86 does have a market leadership in the PC server market of a 75% market share, but I don't believe that they will capture market share in the non-PC server embedded processors market. So to me, that's not too much of a competition. My main worry is actually the RISC-V architecture. In fact, if you read ARM's prospectus, IPO prospectus, they do state this as one of their main threats of competition. So why? Because many of our customers are also supporters of the RISC-V architecture and related technologies. So if RISC-V related technology continues to be developed and market support for RISC-V increases, our customers like Nvidia, Apple, Samsung, Qualcomm may choose to eventually switch and utilize this free open source architecture instead of ARM's products. So again, remember, whenever they use ARM's architecture, they have to pay ARM a licensing fee, a royalty. But if they switch to RISC-V, is a free open source architecture, they don't have to pay licensing fees anymore. So this is their main threat that could disrupt their business model in the future. Now, the next thing I look at before I invest in a business is I always ask this question: what could go wrong? What are the risks that could go wrong in a business? Remember, every business has risk. So especially when you read the prospectus of an IPO, you have to read the, what is the shit that can happen, and they will state it under their risk section. So there are a few risks of ARM that is concerning that I have to highlight. So number one, the first risk is customer concentration. Roughly about 57% of ARM's revenue comes from 5 customers. So if 1 or 2 customers switch, they're in shit house, okay? And out of the top 5 customers, their biggest customer is ARM China. Now, ARM China is not owned by ARM. It's actually owned by other Chinese investors, but they just use the name ARM, all right? And ARM does own about only a 5% stake in the company. And ARM China itself accounts for 24% of ARM's revenue. So there is a bit of a country-specific risk in that case, right? Now, having said that, of course, you've got Apple that has got 20% risk in China as well, and ASML that also has got concentration risk among the top 10 customers. But this concentration risk is a bit high, okay? So, of course, what's the concern? If there's another trade war, if the US or the UK, they ban China from using the ARM architecture, then that could severely hit their revenue and their intrinsic value by about 1/4, okay? The other concern is that it says here, we depend on our commercial relationship with ARM China to access the China market. If that commercial relationship no longer existed, or deteriorates, our ability to compete in China could be materially and adversely affected. In other words, what they're saying is that if Arm China, which is a separate company, decide to screw us, okay, and they take our IP, our intellectual property, and not pay us and steal it and use it for themselves or copy it, then we're in shit house, right? And then we have no way of building our China business, at least in the short term. So that's one risk you have to pay attention to. But the thing that scares me the most is when I read this. It seems that Arm China has not been paying their bills. In Chinese, we say they are chao ka, right? So it says that we have been receiving late payments from Arm China, and we had to expend company resources, getting debt collectors maybe, to obtain payments from Arm China. Arm China represented 40% of our total receivables as of March 31st, 2023. So what are accounts receivables? It's when a company sells the product or sells the service and the customer doesn't pay them. It's accounts receivables. And they're saying that 40% of their accounts receivables comes from Arm China, right? Now think about it. Arm China only contributes 24% of their revenue, but makes up 40% of their accounts receivables. So that goes to show that Arm China is, because of their late payments or maybe non-payments, their accounts receivables could balloon, right? So this is, to me, a red flag in a company, and I'll be a bit concerned to invest in something like this until and unless they can sort this out, all right? Okay, so far, how would I rank the company? Would I say that it's a great business? I wouldn't say that. I wouldn't say it's a great business. It's a good business, but I've got, again, a few concerns. The fact that their revenue flat the last year, their profit declined the last year, their accounts receivables have been growing, all right? Although the good thing is, again, they have got no debt so far, and they've got very high return on equity, okay? Now, the last thing I like to look at is their valuation. Now, again, even if it's a great business, even if it's a fantastic business, remember, a great business is a bad investment if you pay too high a price for the shares. But a great business is a great investment only if you can buy the shares at good value, when it's fairly priced or underpriced. Now, one of the biggest problems I have with IPOs is this. IPOs, I say it's probably overpriced, or IPO stands for insiders profit only. Remember, when you buy shares from an IPO, who's selling you the shares? You're being sold the shares by the insiders, by the company. Now, do you think they're stupid? They're not stupid. If they want to sell you the shares, they want to sell it at the highest price possible, right? They're not doing charity here. So usually when you buy shares in an IPO, you're paying a premium to what the company is worth. But people tend to have this misconception that when I buy an IPO, I'm getting in early. That's the biggest crap myth that people believe in, right? So no, okay? Usually when you buy an IPO, you are overpaying most of the time. Very rarely when you buy an IPO, you're getting a good deal. So anyway, having said that, what are Arm shares worth? And based on their IPO price that they are proposing, is it worth it? Let's take a look. So first of all, they are planning to set their IPO price between $47 to $51 per share, depending on what they can get. Now, let's take the low range. Let's take $47 as the IPO price. Would that be worth it? Okay. So first, we take a look at something simple called the PE ratio and the PS ratio, price to earnings ratio and price to sales ratio. All right. So if you take their share price, which they want to sell it at $47, divided by the earnings per share, the diluted earnings per share, that gives you a PE ratio of 92 times earnings. You're paying 92 times earnings, right? Now, you may say, but NVIDIA, we are paying 100 times earnings, right? Yeah, great. But NVIDIA is growing at freaking 200% a year. They're growing their revenue, their free cash flow, their profits. This guy's not growing in the last 1 year, right? This guy, the revenue is flat and the profit went down. So would I pay 92 times earnings for a company where, in the last year it's not growing? Maybe not, okay? Then you may say, but maybe their profits are temporarily down because of high costs, of high expenses. Fine, all right? Like Amazon. Amazon has got a very high PE ratio that's misleading, okay? Because of the high expenses and capex in the short term, which they'll reduce over time. So for companies like Amazon, we want to look at the price to sales ratio as a better measure, okay? So to calculate the price to sales ratio, we take the share price, $47, which they're proposing to sell us at, divide by the revenue per share, which is $2.61. So that gives us a price to sales ratio of 18 times. Is that high? I think so, all right? So in comparison, if you compare it with AMD's price to sales ratio is only 7. Apple's price to sales ratio, 7. Qualcomm's price to sales ratio is about 3. Amazon's price to sales ratio, 2.6. Okay? So in comparison to these companies, their price to sales ratio is extremely high as well. So I also attempted to do a discounted free cash flow valuation with the limited data that I have. So the first thing is, what is their current free cash flow? We saw it earlier on. Their free cash flow over the last financial year, is $606 million. So I could use that as the free cash flow to project it forward, or I could always take the average of the last 3 years free cash flow. I can do both ways, right? Now, and then I'm going to use roughly a 16% growth projection moving forward based on their net income CAGR of the last 3 years. So using this very limited data, I plugged it into my intrinsic value calculator, which, by the way, that you can get once you enroll in the Value Momentum Investment course, or we call it the Whale Investor course at piranhaprofits.com. You can download this intrinsic value calculator. You learn exactly how to use it, how to value companies. And of course, if you subscribe to the UIP, the Ultimate Investors Playbook, I will value all the different companies in my watch list, in my portfolio every month, so that you don't have to do it. I'll do all the valuation for all my students, as well as identifying all the buy levels and getting my daily live buy and sell alerts. Okay, so having said that, let's take a look. So for ARM Holdings, you can see that I'm being very generous. Okay, I'll put their free cash flow as the average of the last 3 years at $660 million. Okay, now debt, zero debt, cash and short-term investments, $2.04 billion. And I'm going to put in their growth projection of 16.21% for the next 5 years, and then down to 15%, which I usually place for year 6 to year 10, and then with a terminal value of 4% in the last 10 years. They've got about 1 billion shares outstanding. I'm using a discount rate of 8.1%, and that gives me an intrinsic value of, drum roll please, $21.80. There we go. That is the intrinsic value of the stock. And they want to sell it at $47 to $51, right? So if I put in $47, that means they are pricing their shares at 115% premium. Bastards, are they crazy? Am I going to pay 100% for your shares? No. Okay, so forget it, right? It's not a good deal. Now, that doesn't mean that I will discount this stock completely. I will watch it. I think it's a pretty interesting company. Like I said, they've got a white mode, but I do have a few concerns. So what I want to see is I want to wait for it to IPO first and wait for at least the next few quarters of their results to see if that they can grow their revenue again. They can re-accelerate their revenue growth, their free cash flow, their net income growth to get more of a track record before I start buying. I also want to make sure that they sort out their receivables from ARM China, and that is not a concern moving forward. Now, some people would have this fear of missing out, FOMO, like, oh, I got to get in early. What if, the price runs out and I don't get it anymore? Don't worry, relax. I can tell you that historically, even great businesses like Visa, like Facebook, which I bought eventually, right? When it first IPO'd, they didn't go up in a straight line. They didn't, right? They dropped like 50% soon after they IPO'd, which gave you a much better entry price to get in when shares were at a bargain before holding on to the shares for the long run. For example, take a look at Visa. Visa first went IPO back in 2008. And over the last 15 years, they have given fantastic returns. They've been on a very, very strong uptrend and returned 1,750%. Now, did you have to buy at the IPO price to get those great returns? No, right? Visa, after they IPO'd, There were many times that they had big drops, which gave you opportunities to buy in at a better price. So for example, let's take a look at back in 2009, what happened. Okay, let me just scroll back all the way 15 years back and check it out. See what happened. So the stock, IPO'd over here, right? It opened here, and yeah, initially it was a lot of hype, right? It was like, whoa, baby, right? But don't chase. That's why I keep telling people, don't chase the stock once it's run and it's overpriced. It will always come back. If it's meant for you, it will always come back, right? Never chase the girl. Let the girl run into your arms eventually. If she doesn't run into your arms, find another girl or another guy, whatever, right? So what happened, right? Boom, it dropped. Take a look. This was, it was a 53% drop from the high. So you could have gotten in at a much better price, and in fact lower than the actual opening IPO price. So there's always an opportunity. Don't ever have the FOMO and rush it, right? Wait for your price. If you don't get the price, walk away. There are many other great companies out there. How about Meta, which first listed as Facebook? Now Meta, same thing. Look at it. Over the years, it's given a monster return. Of course, we had that big crash last year, but now it's kind of like recovered most of it, and it's up. Let's take a look. 610% since it IPO'd in 2012, which is about 9 years ago, right? About 9 years ago. Now, again, take a look at when it first started. Did you have a chance to get in, even if you missed the IPO price? You bet, right? Check it out, right? So Facebook at the time, it opened here, and then it dropped all the way down to here, right? So it dropped about, let's see, it dropped, well, from the high. It went up initially, and all these suckers bought in because of FOMO, and this guy, this stock dropped, let's see, it dropped 61%. So you always want to wait for a better price. So I hope you have enjoyed this deep dive research into this coming IPO, Holdings. And let's watch it carefully, and let's see if there's an opportunity to buy this stock in the future. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.